There's only 2 trading days left until SoFi's second quarter earnings results. And it's an interesting time because analysts are expecting the company to be absolutely flat from a profitability perspective. The stock has been beaten down over the past several months. Morale is at rock bottom low levels. We have an 18% short interest on the company. And if there's one thing that we know about SoFi, is that they double beat their earnings expectations and raise guidance. Will this quarter be the same? Let's take a look. This video is my Q2 earnings predictions for SoFi. Let's jump in. Okay, so I gave some of my thoughts in the SoFi Weekly podcast last week, but I wanted to expand on some of those thoughts. I have mentioned in previous videos that this second quarter earnings is going to be important because it's actually the one earnings where I'm actually fearful that the company might not do as well, just given where they placed their guidance when they reported their first quarter earnings. This is also why the stock fell down 10% on the back of some pretty good earnings, was the guidance. And so right now, we're going to see what they actually come in. I'm going to walk through some of the guidance numbers. But at first, I want to start off with members because I think members is essentially the leading indicator that leads to all these other numbers. And it's a number that will help us in future quarters understand the growth of this company. It's also a number that a lot of the analysts out there don't even look at. They jump straight into the financials. And so I want to spend a little bit of extra time talking about members and products and then how that translates into the financials. So one thing to understand is that Q2 runs from April to June. And during that time, there's a couple of things that are impacting members. So, first of all, we have some impact from the NBA. This was a deal that they signed back in February. So, there's some awareness around the NBA, but we don't have a full quarter of awareness. I think the awareness is going to pick up when the new season starts off in September towards the end of the year, Q3, Q4. But in terms of Q2, we were sort of at a lull because the season essentially ended throughout there. I mean, one of the things that Chris Hager mentioned in the SoFi Weekly podcast last week was that the Boston Celtics did win the championship. And we know that Jason Tatum is one of the sponsorships for SoFi on their NBA side. So they're running ads during that entire time. There's also going to be some awareness on the golf front with the signing of Wyndham Clark, but nothing super significant on that front either. He didn't really perform very well in the recent championships over Q2. SoFi Stadium, I did mention on Friday, played a key role in the Copa America tournament. I think Mexico played at the stadium. Brazil, Costa Rica was at the stadium. There were several games that were hosted at SoFi Stadium, and that tournament is widely watched and followed. But there weren't really too many campaigns on the marketing side, not very many initiatives, which leads me to doubt that there was an incredible amount of sales and marketing spend to essentially acquire new members. Now, the thing to understand is that in Q1, SoFi brought in 622,000 new members, reaching 8.1 million total members, which represented a 44% increase from the prior year. And this trend has been fairly flat. I mean, they've been at 44% year over year for quite a few quarters now and just generally hovering around that range. I think some of the factors that can influence the Q2 member growth is number one, the flywheel expansion. So as we go towards more financial services products that have lower barriers to entry, we can increase the flywheel of the cross selling between those products, right? So we have SoFi Money, we have Relay, we have SoFi Invest, all of which saw a significant growth in the first quarter of 2024. And I think that this is going to also attract new members, the word of mouth. And you got to keep in mind that as they ramp up financial services, this is the lower barriers to entry suite for SoFi, as opposed to lending, which is a little bit more difficult for people to get into. The second thing to keep in mind is that marketing and partnerships play a crucial role in what the member count ends up being, right? We had the famous 717,000 member quarter, which was when Taylor Swift went to SoFi Stadium, hosted a bunch of events, and that resulted in a huge spike in members, something that we haven't seen since that time. Although there wasn't a significant increase in the marketing initiatives for Q2, there were definitely marketing efforts. I mean, I just mentioned SoFi Stadium with Copa America. There was awareness around NBA. There was awareness around golf. And all of that contributes to the brand and the member acquisition. And the other considerations you have to make when you look at members and products is you have to look at somewhat the macro. And what I mean by this is interest rates, the financial health of potential members, the impact on the macro level to the economy with regards to where rates are. And of course, it goes without saying that favorable market conditions will lead to more members. And I think right now we're at sort of a limbo period because what we know is we know that SoFi is going to be ramping down their lending and they're going to be trying to ramp up aggressively on their financial services side of the business. The other thing to keep in mind is that you always see a bump between Q1 and Q2. Just looking at the charts in the past, you can see some seasonal factors, maybe some correlations in terms of the marketing campaigns. But on the whole, from a marketing perspective, NBA, golf, and the SoFi Stadium impact are my main factors that are contributing to my member count. I mean, I think we're going to see a slight increase in growth in Q2, simply given that seasonality trend. I put 650,000 members as my estimate, which puts their growth rate at around a 40% range. And this estimate assumes consistent performance without accounting for any major new product launches, without accounting for any significant market changes, or anything that could really alter their growth numbers. No, black swan events or anything like that. You just take their numbers and extrapolate them out and try to attribute some of their events and initiatives that they conducted in quarter to see if those actually reflect in the member counts. Now, of course, since there is a strong relationship between members and products with regards to that flywheel, when we get the member number, that's also going to dictate what the product number is to some extent. And I think they will mostly be in the range of 1.5 members to products per their flywheel. However, one thing to keep in mind is that that has been deteriorating over time. In previous quarters, it was 1.52, and then it fell to 1.5, and then it fell to 1.47. And in the most recent quarter, it was around 1.45. So we are getting this phenomena where the products per member number is slightly falling. I actually think, if you want to follow that trend, I think the safest bet is to assume, 1.44 and just extrapolate linearly to follow that trend. And that'll get you to a slightly lower product count. But I think that as they're ramping up financial services, that number is actually going to go up. And the reason why is because financial services have lower barriers to entry. And so I'm predicting over the next couple of quarters, the back half of the year, and starting this quarter that they're going to be reporting, that the products to members count actually starts to go up because there's going to be more members cross-selling into different product lines for SoFi. And so actually in my predictions, I put them at 1.465, which is a slight tick up from the 1.45 products to members ratio that they are right now. Now, very simply put, why do I think financial services will ramp up so aggressively? What is the backbone of this thesis of that product to member ratio going up? Well, simply because in order for the company to meet their own guidance of 75% growth year over year in financial services, the entire segment as a whole needs to ramp up. We know lending is going to slow down. We know FinServe is going to ramp up aggressively. This is what management is focusing on for this year. And the plus side is that this segment, financial services, has lower barriers to entry than the lending segment. And I think anecdotally, we all understand that. Like, it's much easier for us to onboard onto Relay or to onboard onto SoFi Invest than it is for us to get a mortgage or a personal loan through SoFi's lending side. And as a result of these low barriers to entry, the customer acquisition cost is also going to be a fraction of what it would be for higher ticket items. Of course, the profitability of those segments is going to be lower, especially because in many of the business lines for the financial services segment, they're still ramping up that service. So credit cards is a prime example. It's still a money loser from a bottom line perspective, but those business lines are going to be high contributors to the actual growth rates in members and in products. And so really, if you think about it, if SoFi wants to hit the 75% growth, which by and large, they're actually surpassing right now, then they need to ramp up significantly on financial services. And of course, these predictions are rough numbers. I try to think about my predictions for SoFi in a thematic sense. It's just a shot in the dark. I mean, you're never going to get the accurate numbers unless you have a sneak peek at the numbers before they're published. And so for me, really, I'm looking at what I think will happen based on the limited information that is publicly available to me. And if we just plug in 650,000 members, with the 1.465 products to members ratio, like I said, I think that's going to tick upwards given that shift in how they're going to acquire those members. Then we come up to roughly 952,000 new product additions for the quarter. And I think this is going to trickle all the way down in terms of their business segments. As I mentioned, from an individual segment perspective, lending, I don't see that being a huge driver of growth. It's obviously going to be a huge driver of revenue and of profitability for the business. But in terms of the growth rate, we know that they're peeling back, especially with interest rates where they are. And I don't think this is going to be a huge factor for the growth rate. I think financial services, with their really aggressive growth forecasts, in order for them to achieve those numbers, we have to see a strong acceleration in the growth starting this quarter. And we also have to see a strong contribution in the revenue mix. So they're going to have to start doing more money on financial services. And I really think that this will happen more in the back half of the year, so Q3, Q4. But just given this growth rate and how aggressive that percentage is, I think financial services this quarter is going to be a very strong candidate for the segment that's most likely to surprise to the upside for SoFi and contribute to them beating their overall estimates. In terms of the tech platform, I think this is somewhat of a dark horse simply because one thing that I mentioned in the SoFi Weekly podcast on Friday was that this segment is much harder to forecast because it is not a B2C segment, right? It's business to business, and we don't have as much information published online around the tech segment. We don't know the business cycles. We don't know the big deals they have in the pipeline, and we don't know where they are with their proof of concepts with these large banks. All we know is that they're chasing bigger deals, and these bigger deals have larger sales cycles. And beyond that, it's very, very difficult to estimate whether this is going to be a huge beat or whether it's going to be a miss on their numbers. One thing that we do know is that Galileo has been launching new product offerings like clockwork far in excess in terms of their velocity relative to SoFi, and it's executing at a very high degree of consistency. And look, I think from a product velocity perspective, that's really good. If you flip over from a sales perspective, this is one of the points that I mentioned on Friday is that software sales has some seasonality associated with it. And the reason for this is because companies have a fixed budget of how much money they can spend on third party subscription tools to help with their business, which Galileo is a part of, right? And generally, the seasonality is stronger in Q1 and in Q4 and has a trough in Q2 and Q3. And the reason for this is because budgets are left over at the end of the year. And as you know, with budgets, if you've ever been in charge of one, if you don't use it, you lose it. And companies are essentially incentivized to spend that budget because otherwise their budget for the following year is going to shrink. And of course, when the budgets are reset in Q1 for the following year, that's when the companies have money to spend. And so, generally speaking, Q4 and Q1 are the strongest quarters when companies spend money on software. Now, that's a general principle. With Galileo, it might be a little bit different because the sales cycle are so much longer and it takes more time for these businesses to fully integrate and migrate all their accounts over. They need a proof of concept, they need a request for proposal. It's a whole thing. So, this might be stretched out over several years, of course. But generally speaking, I think that's something that I keep in mind is what quarter are we in and where are companies with regards to their budget spend for the year? And just moving over now to a financials perspective, the actual estimates are fairly low for the business. So SoFi expected to be in the range of 555 to 565 million for the quarter. Of course, this is a step down from what they resulted in Q1. I think the business is actually going to come in around 588 million for the quarter. And if you just look at the history of the company beating, generally the beats on the revenue line around 20 to 30 million per quarter. And so I think that number, just given what we've been saying so far around financial services, around these other business segments and where they are in their cycle, like I think 588 is a healthy number. So I do think SoFi is going to beat their estimates, and it's going to beat their estimates by about 20, 23 million on the top end. In terms of the EBITDA, I do think they're going to beat here as well. They're expecting 115 to 125. That's their range. I predicted them to come in closer to 140. So a little bit bigger beat on the EBITDA. But if you just look at previous quarters, we tend to have a bigger beat on the bottom lines than we do on the top lines. And net income, 5 to 10 million. I think this number is a total sandbag. I think they're going to come in much higher than this. Actually, on Friday, in terms of the EPS, I put 1.5 to 2 cents EPS. And after thinking about it for a couple of days, I think that number is actually going to be low. I actually want to revise this estimate higher to 2 cents to 2.5 cents. And the reason why this is significant is because Wall Street analysts are expecting 0 cents. Even though the business reported 2 cents EPS last quarter, the analysts are expecting 0 EPS, basically break even for this quarter. And I think this is a real opportunity for the business to crush analyst estimates and come in at 2 cents EPS. Now, in terms of the guidance, I think this is going to be a really impactful guidance. The second half of the year, I think, is going to be where the company really kicks into gear in terms of their aggressive full year growth targets. That's how they're going to achieve those targets. We know that they have credit card innovations coming towards the back half of the year. We know that they have new announcements that are going to be coming in Q3. And we know that financial services is going to ramp up really heavily, right? Remember that forecast of financial services and technology platform combined is going to make up for about half of the business's revenue. I think SoFi is going to continue to raise their guidance this time around. The trend is generally that they raise it a few percentage points every quarter. And I think that we're going to see a few percentage points to the upside this quarter as well for Q3 and also for the full year 2024. And so essentially, when you put all this together, I think SoFi is absolutely going to continue their trend of triple beating on top line, bottom line, and raising their guidance. And I think this is going to be a quarter where financial services is really going to carry a lot of the weight. And the guidance that they provide, along with the call itself, is going to be very reassuring and setting up the expectations for the back half of the year. And one other thing that I mentioned on Friday is that I do think that as early as Tuesday of next week, they could potentially drop some news around a new product innovation to get the market excited about what to expect going into those future quarters. Analysts are totally letting this one slide under the radar. They're expecting the business to do no money in Q2. Their forecasts over the long tail going into 2026 are absolutely laughable. They're like half of what the actual business is expecting. And if the business releases some new product innovations and they continue to beat their numbers, I think we can be in for a really interesting time with SoFi because keep in mind the latest results for short interest still have the company shorted at 18% short interest. And so you have all of these ingredients here for this perfect storm for SoFi. If they can knock it out of the park with their current quarter numbers and increase their guidance, and on top of that, the cherry on top, drop a new product innovation or at least the promise of a product innovation on Tuesday, that could be the perfect catalyst for the stock to jump higher. Of course, time will tell. I will be live streaming the Q2 earnings on Tuesday morning. So join me on this channel to watch it live. Let me know what you think of the estimates. Is it too bullish or is it not bullish enough? Let me know what you think. Looking forward to reading your comments. See you next time.